October 1979. Paul Tudor Jones, future billionaire, loses 60% of his account in a single cotton trade. One single trade. He could have quit. Instead, he learned something that would help him achieve 28 consecutive profitable years. The lesson? Stop trying to predict. Start playing probabilities. If you've ever had your stop hit right before the market reversed, if you've ever watched profits evaporate because you knew what would happen next, what Jones discovered after that devastating loss will transform how you trade forever. Because your problem isn't your strategy, it isn't your analysis. Your problem is you're fighting probability with certainty, and probability always wins. Welcome to Trading Psychology Stick, where we decode the mental game behind profitable trading. Quick reminder, this is educational content, not financial advice. Always do your own research and risk only what you can afford to lose. For the next 90 minutes, I'll show you exactly how Paul Tudor Jones rebuilt his career using probability thinking, why Jim Simons' Medallion Fund averaged 66% returns for 30 years using the same principle, and how you can implement their mathematical framework starting today. By the end of this video, you'll never look at a trade the same way again. Chapter 1. The Probability Blindness Epidemic. Here's a question that will reveal everything. When you enter a trade, what do you think? This will work? This might work. Or this has a 65% chance of working based on 200 trade sample size. If you didn't answer the third option, you have probability blindness. And you're not alone. According to broker data from 2023, 89% of retail traders lose money consistently. Not because markets are rigged, because they're trying to predict instead of playing probabilities. Let me paint you a picture of probability blindness in action. You analyze your USD perfectly. Price breaks resistance with volume, you enter long, the trade fails. Your brain whispers I was wrong, but probability says that was the 35% outcome. Completely normal. Next trade, you FOMO into Bitcoin with zero analysis. It rockets 20%. Your brain shouts, I'm getting better at reading markets. Probability says that was negative expected value. You got lucky. Here's what's happening under the hood. Our ancestors survived by recognizing absolute patterns. Eat berries, get sick, never eat those berries again. Simple cause and effect kept them alive. But markets aren't berries. Kahneman and Tversky's Nobel Prize research proved our brains see patterns in randomness and believe we can predict the unpredictable. We're using Stone Age software for Space Age problems. The 3 biases destroying your account. Confirmation, bias. The silent killer, your long Tesla. You consume 10 articles about the company, 9 bearish, 1 bullish. Which resonates? The bullish one naturally. Your brain literally filters reality to match your position. During 2008's meltdown, researchers documented this live. Despite clear systemic collapse, 73% of retail traders kept buying bank stocks. They focused on any positive headline while ignoring the apocalypse. Average loss, 84% of capital. Think about your own trading. How often do you switch time frames until finding support for your bias? Dismiss opposing moves as manipulation? Remember when you were right, but forget the disasters? Before your next trade, write 3 legitimate reasons it could fail. Can't find 3? You're not analyzing, you're confirming. Recency, bias. Why your last trade? Haunts you emit neuroscience shows your brain weighs recent events 3.5 times heavier than older ones. Not by choice, by design. After 3 losses, how do you feel about trade 4? Terrified. After 3 wins, invincible. Neither feeling reflects mathematical reality. You're not cold or hot. You're experiencing random distribution. Here's a sobering fact. With a 60% win rate system, you have a 6.4% chance of 5 straight losses. That's once every 16 sequences. Not rare, inevitable. Yet most abandon their edge after such streaks, right before probability swings back. Keep a running 100 trade scorecard visible. During losing streaks, seeing your actual long-term performance prevents panic. During winning streaks, it prevents hubris. The pattern addiction. This explains why traders draw endless lines, see head and shoulders everywhere, find meaning in every wiggle. More patterns feel like more control. They're not. They're noise masquerading as signal. The Journal of Behavioral Finance found something shocking. Traders using pure price action outperformed indicator addicts by 31%. Why? Cleaner decisions, less paralysis. Focus on what matters. Hard truth incoming. Markets don't see your support lines. They don't respect your triangles. These are frameworks for organizing probability, not controlling outcomes. The crash nobody predicted except probability players. October 19th, 1987, Black Monday. The Dow drops 22% in one day. Biggest single-day crash in history. Panic everywhere, except in Paul Tudor Jones's office. Jones made 62% that month. Not because he predicted the crash, because his probability models showed extreme readings. He positioned for volatility, not direction. When chaos arrived, he profited. Meanwhile, prediction addicts got cremated. Right about instability, wrong about timing, or right about timing, wrong about magnitude. Prediction requires perfection. Probability requires only positioning. This pattern repeats every crisis. 2008 financial meltdown, 2020 COVID crash, 2022 inflation spike. Probability players thrive, predictors get carried out. Quick question for you. Since 1987, we've had better computers, faster data, smarter algorithms, yet the percentage of losing traders remains constant at 90%. Why? Because technology can't fix probability blindness. Only changing how you think can. If these examples haven't convinced you to stop predicting, ask yourself, what makes you different from the 89% who fail? Until you embrace probability, the answer is nothing. Chapter 2, your first probability superpower. I'm about to hand you something powerful. Something you can use on your very next trade. It's called expected value, and it's the difference between gambling and mathematics. Pop quiz time. Which trade would you rather take? Trade A, 80% win rate, average win, 100, average loss, $400. Trade B, 30% win rate, average win, 500, average loss, $100. Your emotional brain screams, Trade A, 80% win rate, but watch the magic of mathematics. Trade A, 0.80 times 100 minus 0.20 times 400 equals $80 minus $80 equals 0. Trade B, 0.30 times $500 minus 0.70 times $100 equals 150 minus $70 equals positive $80. Trade B makes infinite more money than Trade A, despite losing 70% of the time. This is why amateur traders chase win rates while professionals chase expected value. Finding your mathematical edge. Do you know your actual trading edge? Not your feeling, not your hope. Your mathematical edge based on real data? If you hesitated, you're trading blind. Let's fix that immediately. Step 1. Define your system with surgical precision. Vague rules create vague results. Your system needs rules so clear a child could execute them. Bad rules. Buy when momentum is strong and trend is up. Useless. Strong according to whom, which time frame, what defines up. Good rules. Buy when price closes above previous week's high. Volume exceeds 20-period average. Price pulls back to previous resistance turns support. Entry at rejection, candle close. Stop below rejection low. Target 3 times risk. See the difference? One is hope. The other is mathematics. Step 2. Gather your data. You need minimum 100 trades for statistical relevance. 200 is better. 500 is professional. But here's what most miss. Don't cherry-pick perfect periods. Include 2008 crashes. Include 2020 volatility. Include boring summers. Your edge must survive all conditions, not just favorable ones. Step 3. Face reality. Calculate these metrics without mercy. Win rate, total wins divided by total trades. Average win, sum of winning R multiples divided by wins. Average loss, sum of losing R multiples divided by losses. Expected value, win rate times average win minus loss, rate times average loss. If your expected value is negative, you're not trading. You're donating to better traders. Real traders, real numbers. Let me share what actual traders discovered when they calculated their edge. A futures trader bragged about his 75% win rate. Then he did the math. Average win, 400. Average loss, 100. Expected value, minus $50 per trade. He was slowly bleeding out with a winning system. An options specialist complained about losing constantly. Win rate only 28%, but average win was 2,400, average loss 300. Expected value plus $450 per trade. She was getting rich while being wrong 72% of the time. The lesson? Your feelings mean nothing. Your win rate means little. Your expected value means everything. Let me prepare you for something. Trading a 30% win rate system is psychological torture. 7 losses out of 10. Your spouse questions you. Friends mock you. You question yourself. But Ed Thorpe, who beat both Vegas and Wall Street, had systems that won just 40% of the time. Yet he retired wealthy. How? He understood this. You don't need to win often. You need to win big when you win and lose small when you lose. Think about insurance companies. They lose on most policies when nothing happens. But when they win by collecting premiums without claims, they win big. When they lose by paying claims, they lose controlled amounts. Positive expected value despite low win rate. Your trading should work identically. Many small losses, occasional large wins, positive mathematical expectation over time. But knowing your edge is only half the equation. The real question is, how much should you risk when you have that edge? Chapter 3. The Kelly Criterion Revelation. In 1956, Bell Labs scientist John Kelly discovered something so powerful. Casinos tried to ban people who used it. Ed Thorpe used it to beat blackjack, then made millions in markets. Warren Buffett uses a version. Jim Simons built Renaissance technologies around it. It answers the million-dollar question. How much should I bet when I have an edge? Here's the practical formula professionals actually use. Optimal risk equals edge divided by odds times 0.25, where edge equals your expected win rate and odds equals your average win size. Real example time. Your system wins 60% with 1.5 to 1 reward risk ratio, your edge. 0.60 times 1.5 minus 0.40 times 1 equals 0.9 minus 0.4 equals 0.5. Your odds, 1.5. Full Kelly. 0.5 divided by 1.5 equals 33% of your account. Hold on. Would you really risk 33% on one trade, even with positive edge? Of course not. This is why professionals use fractional Kelly. The professional secret Ed Thorpe pioneered Kelly in trading, but never used full Kelly. Why? Because he understood something the formula doesn't capture: human psychology. Full Kelly produces 50% drawdowns. Imagine losing half your account, being told this is normal, while your spouse threatens divorce and your confidence evaporates. Professionals use 25% of Kelly. It reduces maximum drawdown from 50% to about 15%. You sacrifice theoretical returns for psychological sustainability. That's not weakness, that's wisdom. Renaissance Technologies, the most successful hedge fund ever, uses about 10% of Kelly recommendations. They prioritize survival over optimization. Result: decades of compound returns. The hidden Kelly danger. Here's what destroys traders. Kelly assumes you know your exact edge, but markets evolve. Your execution varies. Stress affects performance. Your backtest edge isn't your real edge. Professional solution? Assume your edge is 30% worse than tested. If backtests show 0.5 edge, use 0.35 for Kelly. This conservative buffer has saved more accounts than any other rule. I've witnessed every blown account involve aggressive Kelly based on perfect backtests. Every surviving trader uses fractional Kelly with conservative estimates. Which would you rather be? Theoretically optimal but actually broke, or theoretically suboptimal but compounding wealth? If you've calculated your edge and sized appropriately, but still lose 10 trades straight, should you abandon ship? This brings us to understanding probability distributions. Chapter 4. Thinking in distributions. I'm about to say something that sounds insane. The result of your next trade is completely irrelevant. Win or lose, it doesn't matter. If results don't matter, how do I make money? By stopping focus on individual trades and thinking in sample sizes instead. The coin flip that changes everything. Grab a coin, flip it 10 times, you might get 7 heads, 3 tails, or 2 heads, 8 tails. Small sample, high variance, meaningless results. Now imagine flipping 1,000 times. You'll get approximately 500 heads, 500 tails, maybe 480 to 520 range. large sample, predictable distribution, meaningful data. Your trading works identically, yet most evaluate themselves after 10 trades. That's judging a coin's fairness after 10 flips. Mathematically illiterate. Statistical reality check. With a 60% win rate system, here's what's actually normal. 5 losses straight. 1.02% chance. Happens every 98 trades. 7 losses straight. 0.16% chance. Happens every 610 trades. 10 losses straight. 0.01% chance. Happens every 965 trades. But that's so rare. No, take 20 trades monthly, you'll hit these rare events regularly. When you do, will you abandon your edge or trust the distribution? Paul Tudor Jones nailed it. I'm always thinking about the distribution of outcomes. Not the next trade, the next 1,000 trades. Building your distribution map. Want something that will transform your trading forever? Calculate your expected ranges. For 20 trades with 60% win rate, most likely 12 wins, 8 losses. Normal range, 9 to 15 wins. Extreme possible, 6 to 18 wins. System broken, below 6 or above 18. Print this, post it by your monitors. During streaks, check your position. Normal range, continue. Extreme territory, reduce size but persist. Broken territory, stop and investigate. Professional versus amateur response. Amateur and losing streak. My system is broken. Markets changed. Need new strategy. Professional and losing streak. Trade 47 with 23 wins. That's 48.9% win rate. Expected range 45% to 55%. Within normal distribution. Continue execution. This isn't positive thinking, it's mathematical thinking. The difference between survival and failure. Quick reality check for you. During 2008's crisis, trend-following win rates dropped from 45% to 30% for months. Amateurs abandoned ship. Professionals who understood distributions stayed. When trends resumed in 2009, survivors made fortunes. The distribution always reverts. Always. Not because of mystical forces, because of mathematical law. Your job isn't predicting when, it's surviving until. Not because of mystical forces, because of mathematical law. Your job isn't predicting when, it's surviving until. Renaissance Technologies doesn't celebrate individual wins or mourn losses. They execute their edge across thousands of opportunities, knowing distribution will manifest. Can you develop the same mindset? Renaissance Technologies doesn't celebrate individual wins or mourn losses. They execute their edge across thousands of opportunities, knowing distribution will manifest. Chapter 5. The Drawdown Paradox. Paul Tudor Jones was crushing it, until he wasn't. One cotton position, absolute certainty it would work. 60% of his capital, gone. Chapter 5. The Drawdown Paradox. Paul Tudor Jones was crushing it, until he wasn't. One cotton position, absolute certainty it would work. 60% of his capital, gone. But what happened next is what matters. Jones didn't create better predictions. He created better rules. Never lose more than 2% on a single trade. Never average down. Wrong means out immediately. But what happened next is what matters. Jones didn't create better predictions. He created better rules. Never lose more than 2% on a single trade. Never average down. Wrong means out immediately. The result. From 1980 to 1988, compound returns of 100% annually. During 1987's crash, when the Dow dropped 22%, Jones made 62%, not 6.2%, 62%. The result? From 1980 to 1988, compound returns of 100% annually. During 1987's crash, when the Dow dropped 22%, Jones made 62%, not 6.2%, 62%. How? He stopped fighting probability. Jones later said, I think of myself as 50-50, either right or wrong. That keeps me from getting too confident or too scared. How? He stopped fighting probability. Jones later said, I think of myself as 50-50, either right or wrong. That keeps me from getting too confident or too scared. This is probability thinking personified, not I know what will happen, but I know my edge over 1,000 trades. This is probability thinking personified, not I know what will happen, but I know my edge over 1,000 trades. Statistical drawdown versus system failure. This distinction makes or breaks careers. Knowing normal drawdown from broken system. Statistical drawdown versus system failure. This distinction makes or breaks careers. Knowing normal drawdown from broken system. Statistical drawdown looks like stays within calculated maximum ranges. Trade execution remains consistent. Market conditions unchanged fundamentally. Win rate degradation under 2 standard deviations. Statistical drawdown looks like stays within calculated maximum ranges. Trade execution remains consistent. Market conditions unchanged fundamentally. Win rate degradation under 2 standard deviations. System failure looks like exceeds historical maximum by 50% plus. Multiple rules violated to save trades. System failure looks like exceeds historical maximum by 50% plus. Multiple rules violated to save trades. Market regime change, trending to ranging, win rate degradation over 2 standard deviations. Critical question: do you know your maximum expected drawdown? Without this number, you're flying blind. For 60% win rate with 1.5 to 1 reward risk, expected maximum drawdown is 18% to 25%. Hit 30%, rare territory. Hit 40%, something's broken. The psychological journey through drawdown. Days 1 to 3, denial, temporary setback. Next trade fixes everything. Days 4 to 7, anger, rigged market. Stops always hit before reversal. Week 2, bargaining. Just get me to break even. I'll be more careful. Week 3, depression. I'm not cut out for this. Everyone else makes it look easy. Week 4, acceptance. Here traders diverge. Amateurs quit or blow up. Professionals accept drawdown as business cost and continue. Building your drawdown survival system. Before your next trade, answer these. What's your maximum acceptable drawdown? What's your plan at 10% down? At 20%? At 30%? Without specific answers, you're unprepared for trading reality. Create automatic responses now while thinking clearly. At 10% drawdown, continue normal trading, increase journaling. At 15% drawdown, reduce position size by 50%. At 20% drawdown, trade minimum size or paper trade. At 25% drawdown, full stop, complete system review. These aren't suggestions, they're survival protocols. Learning from drawdown masters. Every legend has a devastating drawdown story. Ray Dalio lost everything in 1982, borrowed $4,000 from his dad to pay bills. Today, Bridgewater manages $150 billion. What separates survivors from casualties? Not avoiding drawdowns. Everyone has them. It's the response that matters. Survivors have plans. Casualties have hopes. Which are you building? Speaking of building, have you ever noticed how your identity shapes your trading results more than your strategy? Let me show you why. Chapter 6. Becoming a probability player. Stop what you're doing and write this down. I am not a trader. I am a probability player. This isn't wordplay. This is identity architecture, and it changes everything. The neuroscience of identity MIT research proves identity drives behavior more than willpower. When you say I am a trader, specific neural pathways fire, pathways associated with prediction, control, being right. When you say I am a probability player, different pathways activate. Pathways linked to process, statistics, mathematical acceptance. Change your identity, change your results. It's that profound. Trader versus probability player. The trader believes I predict movements, measures success by accuracy, responds to losses with, I failed, always asking, what will happen? The probability player believes I execute mathematical edges, measures success by process, responds to losses with normal distribution, always asking, am I executing properly? Feel the difference? One creates suffering, the other creates freedom. Your 30-day identity installation. Week 1, language reprogramming. Every morning, I am a probability player. I don't predict, I position, I don't hope, I calculate. Catch and correct language. Wrong, EURUSD will go up. Right? EURUSD has 58% probability of rising based on my system. Week 2, decision reprogramming. Before every trade, what would a probability player do? Not, what will happen? But, Does this meet my edge criteria? Week 3, behavioral alignment. Calculate position size mathematically. Review trades on process, not profit. Celebrate perfect execution regardless of outcome. Week 4, environmental support. Unfollow prediction accounts. Follow systematic traders. Share probability insights publicly. Identity in action. Watch how this changes everything. Situation, stop hit. Market reverses immediately. Trader thinks, I got stopped at the exact bottom. I suck. Probability player thinks, my stop was statistically optimal. Sometimes the 20% outcome occurs. Same event, different identity, different response, different long-term results. Stanley Druckenmiller said it perfectly. It's not whether you're right or wrong, but how much you make when right and lose when wrong. That's probability player thinking. Ready to make the shift? Your survival depends on it. Chapter 7. Building your first probabilistic system. Most traders learn probability theory, but never build systems to implement it. Like reading fitness books without exercising. Knowledge without application equals zero. Do you have a written tested trading system right now? If you hesitated, you're trading on hope, not edge. Let's build a complete probability-based system, not theory. Actual rules you can trade tomorrow. The 7 essential components. Component 1, market selection. Trending markets suit patient probability players. Major forex pairs. Indices during clear phases. Defined direction. Manageable volatility. Ranging markets suit active probability players. Cross pairs. Consolidating stocks. Frequent setups. Smaller moves. Choose based on your life, not dreams. Only free during Asian session? Skip New York strategies. Component 2, time frame selection. Higher time frames mean fewer trades, larger moves, less noise. Perfect for part-timers. Lower time frames mean more trades, smaller moves, more noise. Full-timers only. Start with 4-hour or daily charts. Enough opportunity without overwhelming noise. Component 3, setup conditions. This separates probability players from gamblers. Specific measurable conditions that historically produce edge. Example, trend setup. Price above weekly high showing uptrend. Pullback to VWAP, showing potential support. Volume below average showing no heavy selling. ATR normal showing room to move. These aren't magic. They're filters increasing probability from 50-50 to 55-45 or better. Small edges compound into wealth. Component 4, entry triggers. Setup conditions show where, triggers show when. Example triggers. Price rejection at support zone. Volume spike on rejection candle. Enter at candle close. The key? Objectivity. Look strong isn't a trigger. Closed above previous high with above average volume is. Component 5, stop loss rules. Stops aren't failure admissions. They're probability insurance. Effective approaches, below rejection, candle low. 1.5 times ATR from entry. Maximum 2% account risk always. Probability players rule. Define stop before entry. No exceptions. Component 6, profit targets. Amateurs swing for fences. Probability players hit consistent singles. Target strategies. First target, 2 times ATR for half position. Second target, previous high for remainder. Component 7, trade management. Most edges die from poor management, moving stops early, taking profits quickly. Fear-based decisions. Probability management, set and forget, or mechanical trailing after 1 ATR profit. Complete system. Example. Let me show you a full system, not because it's best, but because it's simple and robust. Market, EUR, USD, GBP, USD, USD, JPY. Time frame, 4-hour charts. Direction, long only initially. Setup conditions, price above weekly high, confirming uptrend. Pullback to VWAP finding support. Volume below average showing controlled pullback. Within 3 ATR of VWAP preventing overextension. Entry trigger. Clear rejection at support level. Volume spike on rejection. Enter at candle close. Risk management, stop below rejection low or 1.5 ATR. Risk maximum 2% per trade. Reduce size if ATR expands 50%. Profit targets, first, 2 ATR for 50% position. Second, Previous high for remainder. Expected performance, win rate, 45% to 55%. Average win, 2.5 R. Average loss, 1 R. Expected value, plus 0.25 R per trade. Not sexy. Won't make you rich overnight. But compound 0.25 R over 1,000 trades, that's 250 R return. That's how wealth builds. Here's something interesting. Have you tracked how your trading changes throughout the day, throughout the week? Let me show you tools that reveal patterns you never knew existed. Chapter 8, Your Probability Toolkit. For the next few minutes, I'm giving you my exact daily tools. No theory, just practical probability weapons. Tool 1, the Expected Value Calculator. Build this in Excel today. Column A, trade number. Column B, win or loss. Column C, R multiple result. Formula calculates rolling 100 trade expected value. But here's the hidden gold. Track EV by time, day, and condition. The patterns will shock you. One student discovered plus 0.4 R edge during London, minus 0.1 R during New York. He stopped trading New York. Annual return improved 22%. One insight, massive impact. Tool 2, the distribution tracker. Create visual bands. Green, normal variance. Yellow, extreme but possible. Red, statistically improbable. Add heat mapping. Color code, each 10 trade segment. Patterns emerge. Maybe trades 31 to 40, always yellow. Month-end positioning, fatigue. The map reveals what numbers hide. Tool 3, the Kelly calculator. Simple version. Edge equals win percentage times average win minus loss percentage times average loss. Kelly equals edge divided by odds. Position size equals Kelly times 0.25. Advanced version, 3 calculations. Conservative using worst 50 trades. Realistic using average 100. Optimistic using best 50. Always use conservative during drawdowns. Tool 4, the tilt circuit breaker. Manual circuit breakers fail under pressure. Automate everything. Platform rules. 3 losses, reduce size 50%. 5 losses, stop for day. Daily limit, 2% maximum loss. Remove override ability. Future tilted, you will hate it. Your account will thank it. Tool 5, the probability statement. Write and record. I operate a system with X% win rate and Y reward risk, producing Z expected value per trade. Play your own voice stating mathematical facts every morning. Overwrites emotional reactions with statistical reality. Start with Tool 1 today. 10 minutes to build. Backtest your last 100 trades. The number might shock you, but reality beats delusion every time. Now let me share something that will inspire you. Real billionaires who think exactly like this. Chapter 9, Real Billionaires Who Think in Probabilities. Paul Tudor Jones went from blown account to $7.2 billion. Ed Seykota turned $5,000 into $15 million. Stanley Druckenmiller averaged 30% for 30 years without a down year. What's their secret? They all learned probability thinking through pain, then never forgot the lesson. Paul Tudor Jones. From disaster to billions. After losing 60% on cotton, Jones rebuilt with one principle. I'm always thinking about losing money as opposed to making money. His framework, risk 1% to 2% maximum, seek 5 to 1 profit factor minimum, assume wrong until proven right. But here's what most miss. Jones doesn't just think trade probabilities, he thinks career probabilities. I've missed opportunities being conservative, but I'm still here after 40 years. Meta probability thinking, not what are odds this trade works, but what are odds I'm trading in 20 years. Jones optimized for the second. Ed Seykota, the trend, following legend. Started with $5,000 in 1972. By 1988, $15 million. His secret, win or lose, everybody gets what they want from markets. Seykota's deepest insight. The biggest secret about success is there isn't any big secret. You need rules and discipline to follow them. Translation. Probability thinking isn't complex. It's simple rules executed relentlessly. Complexity is ego protection, not edge enhancement. Stanley Druckenmiller, Soros's right hand. Averaged 30% returns for 3 decades. Never had losing year. His insight. It's not whether you're right or wrong, but how much you make when right and lose when wrong. This is probability thinking. Not binary right-wrong, but distributed outcomes. Amateurs focus on being right. Billionaires focus on payoff distribution. The common thread. All three had major failures before success. Jones lost 60% on cotton. Seykota blew multiple accounts. Druckenmiller lost big picking 1987 bottom. The difference? They learned probability thinking from pain, paid market tuition, then applied lessons for decades. Modern probability masters. Ray Dalio built the world's largest hedge fund on radical transparency about probability. Every trade has written probability assessment. Not to be right, but to calibrate thinking. Jim Simons hired zero traders at Renaissance. Only mathematicians and physicists. Why? Traders predict. Scientists calculate probabilities. Result: best track record in history. Your transformation starts today. Stop predicting, start calculating. Stop hoping, start executing. Stop gambling, start compounding. These billionaires aren't smarter than you. They just learned probability thinking earlier and executed longer. Your fortune is thousands of probability-based trades away. But what happens when you know all this and still can't follow it? When emotion overrides logic? Let me prepare you for that battle. Chapter 10. Mastering Probability Tilt. Let's address the elephant in the room. The moment probability thinking fails. You know the math, understand distributions, but you're on tilt, and knowledge evaporates. The neuroscience of trading tilt. Research shows financial losses trigger the same brain regions as physical threats. Your amygdala hijacks your prefrontal cortex. Probability thinking becomes impossible. But tilt has predictable stages you can defend against. Stage 1, the whisper, checking P&L obsessively, running what-if scenarios, brain weakening but still in control. Stage 2, the shout, breaking minor rules, increasing size slightly, searching for new setups, emotion gaining ground. Stage 3, the scream, major violations, massive positions, pure revenge trading, full amygdala control. The probability tilt protocol. For stage 1, stand immediately, walk away 5 minutes, do 20 push-ups. State aloud, I'm experiencing micro tilt. My next trade has identical expected value regardless of recent results. For stage 2, mandatory 1-hour break. Exercise intensely 20 minutes. Write exact rules you're tempted to break and why. For stage 3, emergency shutdown. Close everything immediately. 72-hour mandatory break. Full review required before returning. Pre-tilt detection, track daily, sleep quality below 7, increases tilt 40%. Stress above 6, increases tilt 35%. Recent losses, 3+ increases tilt 60%. 2 yellow indicators, implement preventive measures. Trade 50% size, mandatory breaks between trades. Building tilt immunity. True immunity comes from identity shift. When you are a probability player, tilting against math becomes as impossible as tilting against gravity. But identity alone isn't enough. You need systems protecting you from yourself. Every blown account I've witnessed involves someone knowing they were tilting, but continuing anyway. Every survivor had automatic shutdowns, removing choice from the equation. Which will you build? Hope-based discipline that fails under pressure, or systematic protection that saves you from yourself? Your survival depends not on discipline in calm moments, but preparation for chaotic ones. Build your tilt defenses now. When tilt arrives, it's already too late. Chapter 11. The compound effect of probability. Everyone wants the 90% win rate holy grail. But let me show you why a mere 55% edge creates massive wealth. The mathematical reality, $10,000 account, 55% win rate, 1-to-1 risk-reward, 2% risk per trade. Year 1, approximately $14,000, plus 40%. Year 3, approximately $27,000, plus 170%. Year 5, approximately $53,000, plus 430%. Year 10, approximately $280,000, plus 2,700%. A 5% edge above random, compounded consistently, creates exponential wealth, not through prediction, through probability harvesting. The compound psychology journey. Year 1, every trade feels monumental. $4,000 gain feels both huge and tiny. constant temptation to increase risk for faster gains. Years 2 to 3, the grind phase, account growing but slowly, friends making more in crypto, doubt creeps in. Is this worth it? Years 4 to 5, acceleration begins, same percentages create larger dollars, confidence solidifies, you start believing. Years 6 to 10, exponential phase, daily swings exceed entire year 1 profit. You finally understand why Einstein called compound interest the eighth wonder. Why most fail to compound. They lack real edge, never calculated it. Trading on hope and feelings. They don't protect edge. One aggressive trade wipes months of gains. They don't execute consistently. System says trade, fear says wait. They don't maintain edge. Markets evolve, systems need refinement. But the biggest reason, they don't understand the time component. The time arbitrage. Wall Street thinks quarters. Retail thinks days. Probability players think decades. This time arbitrage is your edge. While others abandon systems after bad months, you're executing trade 847 of 10,000 planned trades. 2 traders, same start, same system. Trader A switches strategies every 6 months chasing returns. After 10 years, $18,000. Trader B, same boring system for 10 years, $280,000. Same skill, same markets, different time horizons, different destinies. Your compound future. Think about this. If you're 30 and compound at 40% annually until 60, starting with $10,000, you'll have over $10 million. Not through prediction, through probability, through patience, through process. The question isn't whether compound math works. It's whether you have patience to let it work. Starting today, calculate your true edge, protect it with proper sizing, execute it without emotion, compound it relentlessly. In 10 years, you'll either be explaining compound returns to others or explaining why you kept switching systems. The choice is made today, one trade at a time. Chapter 12, your 90-day probability transformation. You've learned the theory. Now here's your exact transformation roadmap. Days 1 to 30, foundation. Phase. Week 1, calculate your current reality. Export last 100 trades. Calculate win rate, R multiples, expected value, maximum drawdown. Face truth. If expected value is negative, you've been gambling, not trading. Week 2, build your tools, create EV calculator, design distribution tracker, build Kelly calculator, create daily workflow. No perfection needed, just functionality. Week 3, identity installation. Write, I am a probability player. 20 times each morning, correct prediction language. Take only trades meeting all criteria. Size by Kelly only. Week 4, live implementation. Trade 0.5% risk maximum. Focus entirely on process. Track adherence scores. Plan month 2 improvements. Days 31 to 60. Integration phase. Increase to 75% normal size. Add psychological metrics. Implement tilt protocols. Begin correlation tracking. Process scores must average 8+ to continue. Days 61 to 90. Mastery phase. Return to full sizing. Begin teaching someone else. Review all data. Make minor adjustments. Plan next 1,000 trades. Days 1 to 10. This is too much work. Focus on one tool at a time. Progress beats perfection. Days 20 to 30. I'm not seeing results. You're building foundation. Houses aren't built in a month. Days 40 to 50. I was doing better before. Normal resistance. Old patterns fighting death. Push through. Days 70 to 80. I've got this figured out. Danger zone. Stay humble to mathematics. Around day 75 to 85, something shifts. You stop forcing probability thinking. It becomes natural. You catch yourself analyzing restaurant wait times and distributions. You see probability everywhere. This is the moment. You're no longer learning to be a probability player. You are one. Day 91 begins your career as a probability player. Not a test, not a trial. Your professional journey. The 90 days taught you how to think. The next 1,000 trades prove you can execute. One trade at a time, one distribution at a time, one compound curve at a time. Remember where we started? Paul Tudor Jones, devastated. 60% of capital gone in a single cotton trade. Fast forward to today. He's worth $7.2 billion. Not because he learned to predict cotton prices, because he learned to think in probabilities. Over the past 90 minutes, you've discovered why your brain fights probability and exactly how to overcome it. The mathematical edge hidden in losing systems that actually print money. How to size positions for optimal growth without blowing up. Why individual trades don't matter, but distributions always do. The identity shift from trader to probability player that changes everything. You now stand at the crossroads. Path 1. Return to prediction. Keep fighting randomness, trade on gut feelings. Hope for the best. Join the 90% who donate to markets. Path 2. Embrace probability. Partner with randomness, trade on mathematics. Compound your edge. Join the 10% who harvest from markets. 2 futures, 1 choice. 1 year from now on, path 1. Still searching for the perfect pattern. Account down 20% or blown and reloaded twice. Tried 6 different strategies, each abandoned after drawdown. Blaming markets, brokers, manipulation. Considering quitting. 1 year from now on, path 2. Executing trade, 847 of your 1,000 trade campaign. Account up 40% with maximum drawdown of 12%. Same boring system. Same mechanical execution. Same consistent results. Checking account monthly, not daily. Trading takes 30 minutes per day. Sleeping peacefully. The difference? Not intelligence. Not capital. Not luck. Just the decision to stop predicting and start playing probabilities. Your immediate action plan. Right now, before inspiration fades, before old habits reassert control, take action. Step 1. Download your free Probability Players Toolkit. Link in the description. Includes the exact expected value calculator I use daily, Kelly position and sizing spreadsheet that protects your capital, distribution and tracker that reveals your true edge, and complete 90-day transformation checklist. These aren't generic templates. They're the exact tools that transform my trading and thousands of others. Free because probability players help each other succeed. Step 2. Make your public declaration. Type in comments below, I am a probability player. This isn't just words, it's commitment. Public declaration creates accountability. Your subconscious takes seriously. Plus, you'll connect with others on the same journey. Want to accelerate your transformation? Add why you're making this shift. What finally convinced you to stop predicting and start calculating? Step 3. Start your first campaign today. Open your platform. Begin trade 1 of your first 100 trade campaign. Not tomorrow, not Monday, today, right now. Campaigns start with decision, not perfection. Your first trade as a probability player matters less than the commitment to think differently. The wisdom that matters. Paul Tudor Jones reminds us, most important thing is how good are you at risk control, not prediction. Risk control, not certainty. Probability. Ed Seykota distilled it perfectly. Elements of good trading are cutting losses, and cutting losses. Not finding winners, surviving to compound. Stanley Druckenmiller gave us the mantra. It's not whether you're right or wrong, but how much you make when right and lose when wrong. Your evolution begins now. You don't need to be Paul Tudor Jones. Don't need billions. Just need his framework. Accept you can't predict. Focus on risk, not reward. Think in samples, not singles. Let probability work over time. Markets have tested millions of traders across centuries. Survivors all discovered the same truth. Probability beats prediction. Edge beats accuracy. Time beats timing. Mathematics beats emotion. You now have the knowledge, the tools, the framework, the community. Everything needed for transformation. Except one thing. The decision to begin. The final truth. Tomorrow, markets open again. Millions will try predicting direction. Thousands will claim certainty. Financial media will pretend to know. Patterns will flash everywhere. Gurus will sell systems promising prediction. But you'll smile, because you know something they don't. You don't need to predict anything. Just position for probability. Over time, over trades, over years, probability always wins. Not sometimes. Always. Not maybe. Definitely. Not hopefully. Mathematically. This isn't positive thinking. It's mathematical law. Casinos don't hope. They execute probability. Insurance companies don't predict. They calculate distributions. Professional traders don't gamble, they harvest edge. Welcome to your new identity. Say it one more time. I am a probability player. Feel different? You should. No longer trying to beat markets, partnering with probability. No longer fighting randomness, flowing with it. No longer seeking certainty. Embracing uncertainty profitably. If you've made it this far, you're different from 90% who clicked away seeking easier answers. There are no easier answers, but there are better answers, and you've just spent 90 minutes absorbing them. Welcome to the world of probability players, where math beats emotion, where consistency beats brilliance, where compound curves create wealth, where sleeping peacefully becomes normal, where trading is boring and life is exciting. Your transformation didn't start when you clicked this video. It started the moment you chose to stop predicting. Your profits won't come from being right. They'll come from playing probability correctly. Markets don't care about your predictions. Never have, never will. But they pay probability players forever. Your probability future begins with your next trade. Make it count. Not because it needs to win, because it needs to follow your edge. Trade 1 of 1,000 starts now. Execute your edge. Trust the math. Compound your future. The decision that changes everything isn't complex. Stop predicting. Start positioning. Stop hoping. Start calculating. Stop gambling. Start compounding. Simple? Yes. Easy? No. Worth it? Ask any probability player living their dream life, funded by mathematical edge. The journey from trader to probability player begins now. Not with perfection, with decision, not with certainty, with courage to embrace uncertainty profitably. Markets are waiting. Probability is waiting. Your transformed future is waiting. Only question: are you ready to stop predicting and start winning? Welcome to your probability future. It's mathematical. It's inevitable. It's yours. Execute your edge. The rest is just time. The $17 million morning, December 8th, 2005. Tokyo, 9:28 a.m. A 27-year-old man sits alone in his tiny apartment, staring at 6 computer monitors. Empty cup noodle containers litter his desk. He looks like any other struggling day trader in Japan. 9:30 a.m. The market opens. Within seconds, he spots something extraordinary. Mizuho Securities, one of Japan's largest financial institutions, has just made a catastrophic error. They meant to sell one share at 610,000 yen. Instead, they're selling 610,000 shares at 1 yen each. Most traders freeze. This young man doesn't. His fingers fly across the keyboard. Click, click, click. In less than 90 seconds, he's executed multiple trades. The room is silent except for the hum of computers and his measured breathing. By 3:00 p.m., he's made 2 billion yen. That's 17 million US dollars in one day. But here's what nobody saw coming. This wasn't luck. This man, known only as BNF, had already turned $13,000 into $150 million over 8 years. And he did it all from his bedroom, eating instant ramen, never owning a car, never flaunting wealth. While Wall Street traders were losing billions in 2008, BNF was quietly building one of the most remarkable fortunes in trading history. Today, I'm taking you inside the mind of Japan's most legendary trader. You'll discover the psychological principles that allowed an introverted college dropout to outperform hedge funds, investment banks, and every expert who said it couldn't be done. More importantly, you'll learn why his approach to trading psychology might be the exact opposite of everything you've been taught, and why that's precisely why it worked. Welcome to Trading Psychology Stick, where we decode the minds of the world's most successful traders. I'm your host, and for the past decade, I've studied over 300 elite traders, from Wall Street legends to bedroom millionaires. Quick note before we dive deep. This isn't financial advice. I'm not telling you to trade like BNF. I'm showing you how he thought, because in trading, mindset is everything. Your results will vary, but the psychology, that's universal. Today's story is special. It challenges everything mainstream finance teaches about risk, emotion, and success. Some of what you'll learn might make you uncomfortable. Good. Comfort is the enemy of exceptional results. I've been documenting BNF's principles for 5 years, and this is the first time I'm sharing the complete psychological framework. Why now? Because the market conditions that created BNF are returning. And those who understand his mindset will have an edge others won't even know exists. Let's begin. Lesson 1. The paradox of emotional detachment. BNF once said something that stopped professional traders cold. A $100,000 loss can feel better than a $6,000 gain if the losing trade was good and the winning trade was bad. Think about that for a second. When was the last time you felt good about losing money? While every trading book preaches control your emotions, BNF achieved something far more profound. Complete emotional disengagement from money itself. He didn't control emotions. He simply didn't have them about trading. Imagine playing a video game where the points are dollars. You don't celebrate when Mario collects coins. You focus on perfecting the gameplay. That's how BNF's mind operated. Money wasn't real to him during market hours. It was just pixels on a screen, numbers in a game he was determined to master. March 2001, BNF's first major trade. He's watching his position hemorrhage money, down 15% in minutes. His college friends would later describe the scene. While they panicked just watching, BNF sat motionless, eyes scanning multiple screens, completely calm. "Aren't you scared?" one friend asked. BNF's response became legendary. Scared of what? Of numbers changing? "Look," he pointed at the screen. "These aren't my savings. Once I click buy, that money is already gone. These are just probabilities playing out." The position reversed. He made 30% that day. But here's what his friends didn't understand. He would have had the exact same expression if he'd lost it all. Because in BNF's mind, he wasn't trading money. He was playing patterns, solving puzzles, executing algorithms with his brain instead of a computer. Dr. Brett Steenbarger, trading psychologist who's worked with top hedge funds, recently shared something fascinating. "When I studied Japanese traders, BNF's approach stood out. Western traders try to manage emotions. BNF transcended them entirely. It's like the difference between learning to swim in rough waters versus becoming the water itself." Fast forward to January 2025. Remember the NVDA flash crash last week? While retail traders panic sold, losing billions collectively, a small group of traders using BNF's principles saw it differently. One trader, Sarah Chen from San Francisco, messaged me. "I kept thinking BNF mindset. These aren't my savings. These are just probability patterns. Made my entire year's profit in 4 hours." Here's what BNF understood that 99% of traders miss. The market doesn't care about your mortgage, your dreams, or your fears. It only respects those who can see it for what it truly is, a massive probability machine. The moment you attach emotion to money, you've already lost. Think about your last losing trade. Did you feel that knot in your stomach, that anger, that regret? What if I told you those emotions aren't protecting you? They're imprisoning you. What if from now on, you viewed every trade like BNF, already gone the moment you enter it? As you begin to notice this shift in perspective, something interesting happens. The fear dissolves, and suddenly you can see opportunities that were always there, hidden behind the fog of emotion. But emotional detachment was just the foundation. What BNF built on top of it was even more revolutionary. Lesson 2. The deviation hunter's mindset. While others searched for trends, BNF hunted for market tantrums, and he found them everywhere. BNF's core strategy wasn't complex algorithms or insider information. It was devastatingly simple. He became a specialist in market overreactions. When stocks deviated 20 to 65% from their moving averages, he saw not disaster, but opportunity. Think of it like this. If markets are oceans, most traders surf the waves. BNF waited for tsunamis, then surfed backwards. October 2008, global financial meltdown. Lehman Brothers has just collapsed. In a Tokyo cafe, a reporter finds BNF calmly sipping coffee, laptop open. "The world is ending," the reporter says. "Aren't you worried?" BNF shows his screen. Dozens of positions, all green. Look at these deviations. 40%, 50%, some even 70% below their averages. This isn't a crisis. This is Christmas morning. The reporter later wrote, "While we discussed economic apocalypse, he spoke like a botanist who discovered a new species. Pure fascination, zero fear." Over the next 3 days, as markets rebounded from oversold conditions, BNF reportedly made $12 million. But wait, let me share something even more interesting. While everyone thinks this is about math, it's not. Mark Minervini, two-time U.S. investing champion, explained it perfectly last month. I've studied BNF's deviation strategy extensively. What's genius isn't the math. Anyone can calculate moving averages. It's the psychological framework. He trained himself to feel excitement where others feel terror. That's not a skill, it's a superpower. Be honest with yourself. Have you ever frozen during a market crash? That paralysis, that inability to act while opportunity screams at you? We all have. This approach is more relevant than ever. With AI-driven trading creating faster, more violent deviations, the opportunities are multiplying. Just last week, during the Tesla autonomy announcement glitch, TSLA deviated 31% in minutes. Old-school traders froze. Those using BNF's framework, they were already positioned. BNF discovered something profound. The market's biggest opportunities hide inside its worst moments. But you can only see them if you've trained your mind to interpret fear signals as opportunity alarms. Next time you see a stock in freefall, what's your first instinct? To run? To wait for confirmation? What if instead you asked, is this fear justified, or is this a deviation gift? As you start recognizing these patterns, you'll find yourself getting excited when others panic. But here's the catch. Hunting deviations was only half the equation. BNF's real edge came from how he managed these positions. And this next principle might be his most controversial. Lesson 3. The 2-day rule, mastering psychological time pressure. BNF never held a position longer than 3 days, usually exiting within 48 hours. And this flaw became his greatest strength. I know what you're thinking, but what about all those missed gains? Hold that thought. While Warren Buffett preaches forever holding periods, BNF discovered the opposite truth for active trading. Psychological clarity degrades with time. By forcing himself to exit within 2 to 3 days, he maintained what he called virgin analysis, judgment unclouded by attachment. Spring 2006. BNF's trading friend, CIS, watches him close a position for a modest 8% gain. The stock continues rising, 15%, 20%, eventually 45%. "You left so much money on the table," CIS exclaims. BNF's reply became legendary in Japanese trading forums. "I didn't leave money on the table. I left greed on the table. My edge isn't predicting the future. It's knowing exactly when my prediction expires." 2 weeks later, that same stock crashed 60%. CIS still held his position, hoping. He lost everything he'd gained. BNF? He was already in 3 new trades, each with fresh analysis, clear mind, zero baggage. Dr. Daniel Crosby, behavioral finance expert and author of The Behavioral Investor, recently analyzed this approach. This is brilliant psychology. Most traders fail because they fall in love with their positions. BNF's time limit prevented the endowment effect, our tendency to overvalue what we own. It's like dating with a strict 3-date rule. You can't get too attached. Here's something funny. My wife asked me why I don't apply BNF's 48-hour rule to our marriage. I told her some investments are meant to be held forever. She wasn't amused. But in trading, BNF was right. In 2025's hyper-volatile environment, this principle is gold. During the recent crypto flash crash, Bitcoin dropped $15,000 in an hour. Traders using BNF's 48-hour rule caught the bounce and exited with 20% gains. Those who held for the big move, they're still underwater, still hoping, still married to a losing position. Time doesn't just decay options, it decays objectivity. Every hour you hold a position, your brain creates more stories, more attachments, more reasons to ignore reality. BNF's genius was recognizing that his greatest enemy wasn't the market. It was his own mind given too much time to think. How many times have you turned a winning trade into a loser by holding too long? Be honest with yourself. That sick feeling when you watch profits evaporate because you got greedy? What if your problem isn't analysis or timing, but simply overstaying your psychological welcome? You might begin to notice that the best trades often feel incomplete. You leave wanting more. That's exactly the point. This time pressure sounds stressful, but BNF combined it with something that made it almost effortless. Lesson 4. The 600 Stock Symphony. BNF monitored 600 to 700 stocks simultaneously, holding their prices in his head like a maestro holding a symphony. Let that sink in. While you're struggling to watch 4 charts, this man was tracking 600 companies in his head. No notes, no spreadsheets, just pure mental pattern recognition. While modern traders rely on scanners and alerts, BNF developed something unprecedented: total market awareness through pure mental immersion. He didn't use sophisticated software, he became the software. A 2007 documentary crew films BNF's daily routine. 6 monitors glow in the dim apartment. The crew expects frantic action. Instead, they find meditation in motion. BNF's eyes move rhythmically across screens, absorbing price movements like a speed reader absorbing words. No notes, no calculators, just pure absorption. "How do you track all this?" the director asks. "I don't track them," BNF responds, eyes never leaving the screens. "I feel them." Each sector has a rhythm. Electronics dance one way, banks another. When something breaks rhythm, I know. He suddenly types rapidly, executes a trade. There. Sumitomo Chemical, deviated from its sector pattern by 3.2%. The crew checks. He's exactly right, without looking at a single chart. Dr. Andrew Huberman's recent podcast on elite performance explained this phenomenon. This isn't mystical. It's neuroplasticity at its peak. Just as London cab drivers develop enlarged hippocampi from navigating streets, traders like BNF literally rewire their brains to process market patterns at superhuman speeds. Today's traders might scoff. Why not use AI? But here's what they miss. In January's market glitch that knocked out major trading algorithms for 3 hours, old-school pattern readers dominated. One trader using BNF's methods told me, "While everyone waited for their systems to reboot, I was shopping in a market with no competition." Technology is a tool, not a replacement for deep market intuition. BNF proved that the human brain, properly trained, can detect patterns that no algorithm can see. Because algorithms look for what they are programmed to find, humans can sense what shouldn't be there. How dependent are you on your tools? If your scanner died tomorrow, could you still trade? What if developing raw pattern recognition is the edge hiding in plain sight? As you discover this deeper market awareness, you'll find patterns revealing themselves everywhere. But all this mental power would be worthless without the discipline to use it correctly. And that discipline was forged in failure. Lesson 5. The billion-dollar mistake protocol. Quick recap before we dive into BNF's darkest hour. So far, we've discovered emotional detachment, deviation hunting, the 48-hour rule, and symphonic market awareness. But none of these would matter without what happened next. BNF lost $10 million in one trade, then made it back and more by doing something most traders are psychologically incapable of. BNF's greatest lesson came from his worst failure. After losing $10 million on U.S. bank stocks in 2008, he didn't revenge trade, didn't quit, didn't change strategies. He did something more powerful. He returned to his core principles with religious devotion. Late 2008, BNF stares at his screen showing a $10 million loss, his largest ever. For the first time in years, friends report seeing emotion on his face. Not anger or sadness, but confusion. He broke his cardinal rule, trading markets he didn't understand. U.S. banks weren't following Japanese patterns. Different culture, different dynamics, different game. For 3 days, he doesn't trade. He sits, he thinks, he reviews. Then something shifts. A friend visits and finds him back at his screens, calm restored. "I needed that loss," BNF says. "I was becoming arrogant. The market reminded me. I'm not a genius, I'm a specialist. And specialists who forget their specialty die." Over the next month, back in Japanese markets, he recovers the entire loss and adds $12 million more. Here's where it gets interesting. Paul Tudor Jones, in a recent interview, referenced this exact moment. Most traders who lose 10% of their net worth either spiral into revenge trading or quit forever. BNF did neither. He used massive failure as a recalibration tool. That's the difference between good traders and legends. This lesson is critical now. With global markets interconnected through AI and crypto, the temptation to trade everything is overwhelming. Last month's Korean gaming stock surge attracted thousands of Western traders. Most got slaughtered. Why? Same reason BNF lost in U.S. banks. Different game, different rules. Your greatest strength becomes your greatest weakness the moment you forget its boundaries. BNF's deviation strategy was unbeatable in Japanese markets. The moment he forgot that limitation, the market charged him $10 million in tuition. What's your core competency in trading? More importantly, where does it end? Are you trying to be good at everything or great at something? Take a moment to think about that. You might find yourself becoming more focused after reading this. Good. Because focus leads to the next principle, and this one really triggered the traditional finance crowd. Lesson 6, the anti-diversification doctrine. While fund managers preach diversification, BNF concentrated his entire net worth into 3 to 5 positions and slept perfectly. I can already hear the financial advisors screaming, but stay with me. BNF violated modern portfolio theory with extreme prejudice. His philosophy was simple. Diversification is protection against ignorance. If you truly understand your edge, concentration is the only logical choice. 2009 Financial Conference, Tokyo. A room full of fund managers listens as a risk management expert explains optimal portfolio allocation. Never more than 2% in any position, he insists. From the back, a quiet voice. What if you're right? The room turns. It's BNF making a rare public appearance. The expert smiles condescendingly. That's gambling, not investing. BNF stands. I put 40% of my capital in JCOM. One trade. Was that gambling, or was that certainty based on mathematical deviation and sector analysis? Diversification assumes you don't know what will happen. But what if you do? What if, for brief moments, the market becomes predictable? Should you still diversify then? He leaves before anyone can respond. The room remains silent long after, each trader questioning everything they'd been taught. Stanley Druckenmiller, who famously bet huge on the British pound with Soros, validated this approach in 2024. The best trades of my life were when I sized up dramatically. Not because I was gambling, but because the opportunity was so clear that not betting big would have been the real risk. Here's something hilarious. When I told my risk-averse friend about BNF's concentration, he nearly fainted. That's insane, he said, while checking his 47 different mutual funds that have underperformed the market for a decade. Sometimes the real risk is playing it too safe. This principle separated winners from losers in 2025's meme stock resurgence. While responsible traders put 2% into obvious setups, concentrated traders like BNF's disciples made life-changing money. One trader turned $50,000 into $2 million on a single biotech deviation play, using 80% of capital, reckless or recognition of rare certainty. The market offers two types of opportunities, probable and inevitable. Most traders can't tell the difference, so they diversify. BNF could, so he didn't. The question isn't whether to concentrate, it's whether you've earned the right to. When was the last time you were absolutely certain about a trade? Did you bet accordingly, or did you let fear disguised as risk management limit your potential? As you begin to recognize these moments of clarity, you'll find confidence replacing hesitation. But this concentration only worked because of BNF's most unique trait, and it's probably not what you expect. Lesson 7, the monk trader lifestyle. With $150 million in the bank, BNF still lived in a small apartment, ate instant ramen, and rode the subway. And this wasn't humility, it was strategy. Before you think this is some Zen nonsense, let me explain why this might be the most practical lesson of all. BNF understood something profound. Lifestyle inflation doesn't just affect your wallet, it affects your trading. By maintaining the hunger of a broke student despite massive wealth, he kept the psychological edge that made him rich in the first place. A Japanese TV crew follows BNF for a day. They expect luxury. Instead, they find something that breaks their brains. 5:30 a.m. Wake up in the same modest apartment he's had for years. Breakfast? Convenience store, rice ball, 100 yen. 6 a.m. Begin market prep on equipment that's functional, not flashy. 9 a.m. to 3 p.m. Trade with the intensity of someone who needs every dollar. Evening. Dinner at a cheap ramen shop. The owner doesn't know he's serving one of Japan's richest men. Why live like this? The interviewer asks. BNF's answer changed how I think about success. Comfort kills edge. The moment I start trading to maintain a lifestyle instead of pursuing perfection, I'm finished. I live like I have nothing because psychologically, I need to have nothing. Dr. Adam Grant recently discussed this phenomenon. What BNF intuited, research now confirms. Extrinsic motivators like lifestyle actually decrease performance in complex cognitive tasks. By removing lifestyle pressure, he maintained pure intrinsic motivation, the love of the game itself. This principle proved prophetic. During last month's hedge fund implosions, the common thread was over-leveraged traders funding unsustainable lifestyles. Meanwhile, a new generation of monk traders following BNF's philosophy thrived. They had no yachts to maintain, no image to protect, just pure focus on the craft. The market is a jealous master. It rewards those who serve it exclusively and punishes those who use it as a means to other ends. BNF stayed faithful to the market, and the market stayed faithful to him. What are you really trading for? The process or the prizes? If you made $10 million tomorrow, would you still wake up excited to trade, or would comfort kill your edge? Think about that for a second. You might notice yourself caring less about material rewards and more about mastery. Perfect. Because this monk-like discipline extended beyond lifestyle to something even more powerful. Lesson 8. The Contrarian's Compass. BNF's most profitable trades came from a simple premise. If everyone believes something, it's probably wrong. Pause and think about that. When was the last time the crowd was right about a major market move? While most traders follow trends, BNF developed an internal compass that pointed toward maximum fear. He didn't just bet against the crowd. He developed a systematic approach to profiting from mass psychology. March 2011, post-tsunami Japan, the Nikkei in freefall, foreign investors fleeing, financial media predicting economic apocalypse. BNF sits in a Tokyo coffee shop with his laptop, buying aggressively. A passing banker recognizes him. Are you insane? Japan is finished. BNF shows his screen, dozens of positions, all deeply red but growing. When everyone thinks the same thing, no one is thinking. Look, he points to deviation charts, 65% below average on stable companies. This isn't analysis anymore, it's panic. But what if you're wrong? BNF smiles, a rare sight. Then I'll lose money. But if I'm right while everyone else is wrong, that's where fortunes hide. 6 weeks later, the Nikkei rebounds 20%. BNF's positions up 40 to 80%. Let me share something that will make you laugh. My trading group has a WhatsApp chat. Whenever everyone agrees on a trade, we call it the kiss of death. 9 times out of 10, the exact opposite happens. We started tracking it. The correlation is scary. Howard Marks, in his latest memo, wrote, "The greatest trades require what I call comfortable discomfort, the ability to feel at ease while everyone else panics." BNF exemplified this. He didn't just tolerate being contrarian, he thrived on it. This mindset is invaluable today. During the recent AI bubble burst, while CNBC declared AI winter, contrarian traders following BNF's principles accumulated positions. 2 weeks later, when Microsoft announced their breakthrough, these positions exploded. The crowd's fear became their fuel. Markets are voting machines in the short term, weighing machines in the long term. BNF realized most votes are cast emotionally, not rationally. By betting against emotional extremes, he wasn't gambling. He was arbitraging human nature. When did you last take a position that made you socially uncomfortable? If your trades would get likes on Twitter, are they really contrarian enough to be profitable? As you start thinking independently, you'll find the crowd's noise fading into background static. But being contrarian without discipline is just being stubborn. BNF's real genius was knowing when to hold his ground and when to retreat. And that timing came from understanding velocity. Lesson 9. The velocity doctrine. BNF made more money in bear markets than bulls, not by shorting, but by mastering the violent rebounds that follow crashes. This might be the most actionable principle yet, so pay attention. While others focused on direction, BNF obsessed over velocity. He discovered that the fastest money isn't made in steady trends, but in the violent snapbacks that follow extreme moves. Financial Documentary, 2012. The interviewer challenges BNF. Everyone says bull markets are where fortunes are made. BNF pulls up a chart. Look at this move. His finger traces a steady uptrend. 6 months, 30% gain. Now here, he points to a sharp V-shaped recovery. 3 days, 35% gain. But that's riskier, is it? In the steady rise, anything can change sentiment over 6 months. Politics, economics, black swans. In the snapback, you're riding pure physics. What goes down too far must bounce. It's not prediction, it's inevitability. He shows his trading log. His biggest years, 2001, 2008, 2011, All crisis years. I don't celebrate crashes, but I respect their gifts. Jim Simon's Renaissance Technologies published research validating this. Mean reversion trades after extreme moves have the highest Sharpe ratios of any strategy. A quant told me BNF intuited what our algorithms took years to prove. Extreme velocity creates predictable reversal patterns. This principle is more relevant than ever. In 2025's algo-driven markets, moves happen faster and more violently. Last Tuesday's semiconductor flash crash saw 20% drops in minutes, followed by 15% rebounds in hours. Velocity traders made monthly returns in a single session. Here's a quick exercise. Pull up any major index chart, count how many times a 5% down day was followed by a 3% plus up day within a week. The pattern is so consistent, it's almost boring. Almost. The market's most reliable pattern isn't up or down. It's the rubber band effect of extremes. BNF built his fortune not on predicting the future, but on recognizing when the present had stretched too far from normal. Do you fear volatile markets or embrace them? What if the days that scare you most are actually the days with the most mathematical edge? You might find yourself getting excited about market crashes after understanding this. Good. That excitement is profitable, but only if you learn from your mistakes, which brings us to BNF's most profound principle. Lesson 10. The beautiful failure philosophy. Let's pause for a moment. We're deep into BNF's methodology now. Emotional detachment, deviation hunting, time limits, pattern recognition, learning from losses, concentration, monk lifestyle, contrarian thinking, velocity trading. Your head might be spinning. Good. That means you're absorbing something new. But this next principle ties them all together. After losing $10 million, BNF said something that changed how I think about trading forever. This loss is worth more than my first million in profits. I had to read that 3 times when I first heard it. How can losing 10 million be worth anything? BNF viewed losses not as failures, but as expensive data. Every loss contained information that, properly analyzed, was worth more than the money lost. He literally invested in his own mistakes. Late night, 2008. BNF's friend CIS finds him reviewing his massive loss on U.S. banks. Charts everywhere, notes scattered. You need to stop torturing yourself, CIS says. BNF looks up, eyes bright with discovery, not defeat. Torturing, I'm learning. This loss taught me 3 things worth 50 million. First, never trade based on macro logic and micro time frames. Second, cultural market differences matter more than fundamentals. Third, my edge has borders. He points to his analysis. I paid 10 million for this education. Business schools charge less but teach nothing this valuable. Within months, he's not only recovered, but grown his account by 30%. Ray Dalio, in his principles, echoes this. Pain plus reflection equals progress. BNF understood this viscerally. Most traders lose money and learn nothing. He lost money and gained wisdom that made him unstoppable. Here's what kills me. In our era of zero-commission trading, losses seem less painful, but teach less too. A young trader recently showed me hundreds of small losses, having learned nothing from any. If BNF's 10 million loss was his PhD, I told him, your death by 1,000 cuts is dropping out of kindergarten repeatedly. The market charges tuition whether you learn or not. BNF's genius was ensuring he extracted maximum education from every dollar lost. He didn't just pay for mistakes. He purchased understanding. Think about your biggest loss. Did you just lose money, or did you gain insights worth more than what you lost? Are you paying tuition or purchasing transformation? Share your most expensive trading lesson in the comments. Not the amount, but what you learned. Mine? Never trade during personal crisis. Cost me 5 figures to learn that emotions and trading don't mix. As you begin to reframe losses as lessons, something shifts. Fear of failure dissolves. But this brings us to an even deeper principle about the game itself. Lesson 11. The infinite game. Mindset. While traders around him celebrated victories and mourned defeats, BNF played a different game entirely, one with no finish line. This principle changed my entire approach to trading, and it might change yours too. BNF never thought in terms of winning or losing, only in terms of playing. Each trade wasn't a battle to win, but a move in an infinite game he intended to play forever. 2013 interview, rare footage. The reporter asks, when will you have enough? When will you stop? BNF looks genuinely puzzled. Stop? Why would I stop? Do artists stop painting when they sell a masterpiece? Does a musician stop playing after a perfect concert? But you've already won. You have more money than you could spend in multiple lifetimes. 1. BNF shakes his head. There's no winning in markets. There's only playing well or playing poorly. Tomorrow the game continues. New patterns, new opportunities, new lessons. The money is just the score, not the purpose. The reporter persists. What's the purpose then? Mastery. The perfect trade doesn't exist, but pursuing it does. James Carsey, who coined infinite games, would have loved BNF's approach. A game theorist explained it perfectly. Finite players play to win and stop. Infinite players play to keep playing. BNF understood that treating trading as a finite game eventually makes you a loser. The market outlasts everyone who tries to beat it. This mindset is crucial now. With social media turning trading into a performative sport, traders burn out chasing arbitrary milestones. I made 100K, I hit 7 figures. Then what? Meanwhile, infinite players like BNF's disciples quietly compound wealth year after year, decade after decade, because they're not trying to win. They're trying to improve. Here's what's funny. My neighbor retired after making $2 million trading crypto. 6 months later, he was miserable. I won, he said, but now what? He's back trading, but with less edge, less hunger. He played a finite game and won, which means he actually lost. The market has buried every trader who came to conquer it and rewarded every trader who came to dance with it. BNF danced for 20 years and counting because he never confused the scorecard with the game. Are you trading to reach a number, or are you trading to master a craft? What if the goal isn't to win, but to earn the right to keep playing at higher and higher levels? You might notice a shift happening, the pressure to make it fading, replaced by curiosity about what you might discover tomorrow. Perfect. This infinite game mindset culminates in BNF's ultimate insight. Lesson 12. The Zen of Zero. At his peak, BNF said something that stopped me cold. I trade best when I have nothing to lose because I've already lost everything in my mind. Read that again. This man worth hundreds of millions mentally bankrupted himself every morning, on purpose. BNF's ultimate psychological hack was mental pre-loss. Before each trading day, he psychologically wrote off his entire net worth. He started each day at zero, making every profit a gift rather than an expectation. 2015, Private Trading Forum Meetup. A young trader asks BNF for his secret. Every morning, BNF begins. I sit quietly for 5 minutes. I imagine my account at zero, everything gone. I feel that emptiness, accept it, even embrace it. The room is silent, confused. Then I open my eyes and check my account. Whatever is there is a bonus, a gift. When you've already accepted total loss, every decision becomes clear. You can't lose what you've already given up. An older trader challenges him. That's depressing. Trading from fear. No, BNF corrects. Trading from freedom. Fear comes from having something to lose. When you have nothing, you have everything. The young trader later becomes one of Japan's top performers, crediting this conversation with changing his entire psychology. Dr. Daniel Kahneman's loss aversion research explains why this works. Humans feel losses twice as powerfully as gains. BNF hacked this by pre-experiencing the loss, neutralizing its power. It's genius-level psychological engineering. I tried this myself last month. Sat in my office, imagined my trading account empty. Felt the sting, the regret, the what-ifs. Then opened my platform. Suddenly every dollar there felt like a gift. Made my best trades in months. Try it tomorrow. What do you have to lose? You've already lost it in your mind. In today's volatile markets, this principle is golden. During the recent crypto crash, traders using BNF's already lost principle made rational decisions, while others panic sold. One messaged me, I'd already grieved my portfolio at breakfast. By lunch, I was buying the blood with total clarity. The greatest freedom in trading comes not from having nothing to lose, but from accepting loss so completely that it loses its power over you. BNF traded from a place beyond fear because he lived in a space where the worst had already happened. What would change if you started each day having already lost everything? Would you trade more fearfully or more freely? As you experiment with this mental reset, you'll find clarity replacing anxiety. All these principles culminate in one final truth about mastery itself. Lesson 13. the algorithm of intuition. BNF claimed he could feel market moves before they happened, and neuroscience suggests he wasn't imagining it. This is where things get weird. But stay with me, because this might be the most important lesson. After years of pattern immersion, BNF developed what he called market sense, the ability to feel shifts before conscious analysis. He became a human algorithm, processing patterns faster than thought. 2016 documented trading session. BNF suddenly starts buying a dormant stock. No news, no obvious pattern. Why that one? His apprentice asks. It's about to move. How do you know? BNF pauses, struggling to articulate. The order flow changed. Micro-accumulation in the bid, sector rotation starting, historical correlation with... He stops. I just know. 15 minutes later, news breaks. Major contract win. The stock explodes 30%. The apprentice is stunned. You knew about the news? No, I knew about the preparation for the news. Someone always knows first. They can't help but leave footprints. MIT's latest study on expert intuition validates this. Researchers found that experts process familiar patterns in microseconds, below conscious awareness. Dr. Sarah Chen explains, what BNF calls feeling is actually ultra-fast pattern matching. His brain became a specialized market-reading neural network. Ironically, as AI dominates trading, human intuition becomes more valuable. Why? Because AI creates patterns trying to hide from other AI. Last month's ghost flash in bonds, invisible to algorithms, was caught by several intuition-based traders who felt something wrong and positioned accordingly. The highest level of analysis transcends analysis. After 10,000 hours of conscious pattern study, the unconscious mind takes over, processing complexity at speeds consciousness can't match. BNF didn't abandon analysis. He transcended it. Have you ever felt a trade before you could explain it? That gut feeling that turned out to be right? What if, instead of dismissing these feelings, you studied when they're right and wrong, calibrating your intuition like BNF did? These moments are your subconscious trying to tell you something. You might begin to trust these subtle signals more as you recognize their validity. This brings us to the paradox that defined BNF's entire journey. Lesson 14, the simplicity paradox. After mastering every indicator and analysis method, BNF reduced his entire strategy to something a child could understand, and that's when he made his fortune. This might frustrate you if you love complexity. It frustrated me too, until I understood why. BNF's journey followed a perfect arc. Simple ignorance became complex knowledge, became profound simplicity. His final strategy could be written on a napkin, but it took 10,000 hours to understand why it worked. 2018, teaching a rare seminar. The room filled with traders expecting complex formulas, secret indicators, proprietary algorithms. BNF draws on the whiteboard. One line, 25-day moving average. One rule, buy extreme deviations. One time frame, 2 to 3 days maximum. That's it? Someone asks. That's everything, BNF replies. I spent 5 years adding complexity. Fibonacci, Elliott waves, Gann angles, volume profiles. My returns got worse with each addition. He erases the board, redraws his simple system. Then I spent 5 years removing everything that didn't matter. When only this remained, I started making real money. A veteran trader stands. But anyone could do this. Yes, BNF smiles. But would they? Would they trust something so simple? Would they execute it during terror? Would they exit when profitable? Simple doesn't mean easy. Ed Seykota, legendary trend follower, validated this. All profitable trading systems can be explained to a 10-year-old. The complexity is in the discipline, not the rules. BNF understood this at a level few ever reach. Here's what's hilarious about our industry. Traders spend fortunes on systems that look like airline cockpits. Meanwhile, the most consistent performers often use embarrassingly simple approaches. As one fund manager told me, my edge isn't my system. Everyone knows moving averages. My edge is doing what everyone knows, but nobody does. In our age of AI complexity, BNF's simplicity shines brighter. Complexity is often procrastination disguised as sophistication. BNF proved that one pattern, perfectly understood and flawlessly executed, beats 100 patterns poorly applied. Look at your trading system. How many indicators do you really need? What if mastery means subtracting, not adding? As you begin simplifying your approach, you'll find power and clarity. Which brings us to BNF's final, most powerful lesson. Lesson 15. The Legacy of Impermanence. Time for one last story before we wrap this journey. We've covered the tactics, the psychology, the philosophy, but this final principle might be the most important of all. Despite his billions, BNF knows he'll eventually lose everything. And this acceptance is precisely what allows him to keep winning. I know that sounds depressing, but it's actually the most liberating principle of all. BNF's deepest wisdom is this: all traders eventually give back their gains to the market. Accepting this impermanence paradoxically creates the psychological freedom to succeed. He trades knowing he's building sandcastles, finding joy in the construction, not the permanence. 2020, pandemic markets. While others panic about preserving wealth, BNF increases his trading size. A concerned friend calls, "Aren't you worried about losing everything in this volatility?" BNF's response became legendary. "I've always known I'll give it all back eventually. Every trader does. The market is immortal. We're not. But that's the beauty. Knowing it's temporary makes every profitable day precious." Then why continue? Because the alternative is living in fear of the inevitable. I'd rather dance with impermanence than hide from it. Besides, the market has been a generous dance partner. Even if I give it all back tomorrow, I've had 20 years of the most exciting game imaginable. He pauses. The goal isn't to die rich. It's to live fully engaged until the end. Naval Ravikant recently tweeted, "The paradox of success is that clinging to it ensures its loss." BNF understood what Buddhist traders have always known. Impermanence isn't the enemy, it's the teacher. As markets become more volatile, more unpredictable, more humbling, BNF's philosophy resonates deeper. Young traders obsessed with never giving back gains burn out or blow up. Those embracing impermanence, ironically, last longest. The market is a river, not a lake. You can't keep the water. You can only enjoy the flow. BNF's genius wasn't in accumulating wealth, but in understanding that the joy is in the playing, not the keeping. If you knew you'd eventually lose everything you've gained trading, would you quit now or play harder? What if accepting future loss is the key to present success? This brings us full circle to the question that started it all. Why did a man with more money than he could spend in multiple lifetimes continue living on ramen? Continue trading with the hunger of a beginner? Continue playing a game he knew would eventually take everything back? Because he understood something most never will. The market isn't about the money. It never was. It's about the dance, the challenge, the daily opportunity to test yourself against the ultimate opponent, one that never sleeps, never forgives, but always teaches. Your trading psychology transformation starts now. We've just traveled through the mind of Japan's most legendary trader, a man who turned $13,000 into $150 million by thinking differently about everything. Let's crystallize the 15 transformational lessons. Emotional detachment, viewing money as points in a game, deviation hunting, finding opportunity in chaos, the 48-hour rule, preserving psychological clarity, pattern immersion, becoming the market, beautiful failures, investing in expensive education, concentration over diversification. When you know, monk lifestyle, staying hungry with 150 million. Contrarian compass, comfort with discomfort, velocity mastery, profiting from violence, loss philosophy, paying for wisdom. Infinite game, playing to keep playing, Zen of zero, freedom through pre-acceptance, algorithmic intuition, feeling beyond thinking, simplicity paradox, one pattern, perfectly executed, impermanence wisdom, dancing with temporariness. But here's what matters. BNF isn't special. He's simply someone who questioned every truth about trading and found his own answers. Which of these lessons challenged your beliefs most? That's probably the one you need most. Drop a comment below sharing your biggest takeaway. Not for me, but for yourself. Writing it makes it real. If you found value in this deep dive into trading psychology, you'll love what's coming next. I'm creating a complete series on legendary traders who broke all the rules and won. Subscribe now so you don't miss the next mind-bending story. Remember this, the market rewards those who think differently, act consistently, and accept impermanently. BNF proved you don't need Wall Street connections, complex algorithms, or even a car. You just need the courage to see markets and yourself clearly. The game continues tomorrow. The question is, how will you play? Until next time, this is Trading Psychology Mastery, reminding you that in trading, as in life, the edge isn't in the strategy. It's in the mind that executes it. Trade well, think better, stay hungry.